All right. So the course of our last, we discussed about liquidity, the brief introduction to liquidity, and we talked about liquidity and things. And I think we said that liquidity is basically how easy it is to convert an asset into cash. Then later related it to the trading environment, that we need to understand that almost everywhere in the market is liquidity. For a market to actually function, what do I mean when I say market to actually function? That means for the buying and selling activity to actually take place, we need liquidity. All right. For the buying activity to actually take place, there needs to be liquidity. Take for instance, before someone can buy, they need to be what? Sellers. Before someone can sell, they need to be what? Buyers. So liquidity is more or less the only thing that keep that balance between the buyers and the sellers, making sure that the sellers are adequate enough and the buyers are adequate enough to settle each other for the market to actually do what? To move. So with that being said, I think there's one of the reasons why we actually look into liquidity is basically because of the other part of liquidity, which is the one that the smart money uses against retail traders, which I will more or less call the trap liquidity. All right. This the liquidity in the market that more or less is a fake move in the market, a fake move in the market to induce we retail traders into placing positions at the places that we should not. Take for instance now, for those of you who have started trading already, you most likely figure out that at some point in time, you will place your trade with what will happen next is that you will hit SL. After hitting SL, the trade will go to your direction. After it SL, you go smash the after it SL, you go smash TP. Now, the reason for this is because the markets have now used you as liquidity to actually push the market further. Right? I think I explained this thing already during the last class. That is why majority of us actually lost our trade, being unable to identify the liquidity. Many people, many beginners that you see out there that with trading with SFC, anyway, so they see other block, they just place trade. What's going to happen? They go hit SL is because they know they are failed to identify their liquidity properly. That's why they are having all those issues of it and all that. All right. So liquidity is very crucial to you as a retail trader, not just to the market. So you as a retail trader, liquidity is very crucial. You need to understand where liquidity is in the market because the smart money guys will not come and trade unless they have taken liquidity. They have to take liquidity so that there will be efficient liquidity to actually satisfy their order. Take for instance, like I said during the listing, take for instance a smart money guy wants to buy like let me say $20 million worth of anything. Okay, let me use crypto coin. $20 million worth of a crypto coin. So what will happen? Perhaps the only this thing available at that point in time, the only people that want to sell is perhaps let me just say just 5 million worth of that particular coin is up for sale. So the smart money guys will have to do what? Look for a way to manipulate the market to make people to start selling off so that there will be a lot of sellers in the market because many people are holding their this thing and they keep on buying. So they have to look for a way to make all these people sell off. And that's why you most likely see all this fall in crypto sometimes. So they have to make all these people sell off, all these retail traders, make us, when we lose our this thing, when we sell off that particular thing, when we not hold them again, panic sales of a thing like that because many people, the market is crashing. So what we just need to do that, at that point in time, our psychology will just be telling us to secure our capital. So if we are holding, we have to sell off and all that. And when the quantity have reached the amount that the smart money guy wants, from 5 million, they don't sell. That means there are a lot of penny sell this thing in the market, a lot of coins now that is up to 20 million. What will happen? The smart money guy will then buy, he then fill that is order that he wants to fill. And when he fill that order, the next thing we see next is boom. That's why check very well. Whenever there's a liquidation in the crypto market, what happens next is a sharp movement to the upside. When crypto fall, the next thing again, a sharp movement, fiam. Next one you go hear be say BTC don't hit another new all-time high or stuff like that. So this is just basically how liquidity, how the smart money guys hunt for liquidity. They didn't know this liquidity to do also fill in their orders. The same thing goes for each and every other market as well. All right. Now, with that being said, we as the retail traders, what do we need to do? Remember, we are trading the smart money concept. And since we are going to follow the smart money guys, be we have to be playing their games. We have to understand their games very well. And that is why liquidity is one of the most crucial things when it comes to smart money concepts. And it is the only thing that differentiates normal smart money concept from advanced smart money concept. When you understand liquidity very well, it means that you're now on an advanced level of using that your SMC. All right. So with that being said, let's go right into the types of liquidity that we have, which I already talked yesterday. We have the internal liquidity and we have the external liquidity. Like I said, for a research trader, it is very crucial to identify liquidity before any other thing in the market. All right. Once you have your direction, you already know the direction of the market. The next thing you should look for next is your liquidity. You need to look for your liquidity because if you fail as a retail trader to look for your liquidity, you will then be the liquidity that market is going to use. That is the rule of the game. You have to look for the liquidity or you become the liquidity that market is going to do what it's going to use. All right. So with that being said, I think we talked about the external liquidity yesterday. Where we talked about the external liquidity. They are the ones at the extreme levels of the charts. Let me share my screen. So, like I said, the external liquidity, they are the ones at the extreme level of the chart. Take, for instance, if this is to be my chart, now, where are the extreme levels that we have in the market? The extreme levels that we have in the market is where your points of rejection is. After all, that is the highest place or the lowest place that price got to before it was rejected. So it was the extreme level that price was able to reach, was able to attain before the rejection came in. So those your highs and your lows, they are now the extreme levels that we have. After all, when we're talking about the liquidity during our last class, we already made mention of the other liquidity based on market mechanics that liquidity is most likely resting more often on your other blocks. That means where people are placing their trade, not just other blocks, all right? Wherever people are placing their trade, that's where liquidity is because that's where buying and selling is taking place in the market. I know that liquidity is what it's in fact is the fuel for this buying and selling activities of a thing. There have to be a lot of liquidity for all this buying and selling to actually take place. Thing and all that. Liquidity is basically just money. All right, it's what makes the market to move and all that. So, with that being said, where do you find all these levels, all this high volume of buying and selling? Where do you find it in the chart? You find it at your highs and your what and your lows. That's where you most likely find them because if you check very well, most of all these our market mechanics, some of our complex of market mechanics, they are resting at the highs and the lows. So liquidity is not resting at the highs and the lows because people that are taking trade most likely place their stop loss just above the high and just below the low in most cases. All right, that's why the best way to actually point out liquidity is by using the highs and the lows instead. So with that being said, the most extreme place when it comes to external liquidity are your highs and your lows, in which, and please, the only difference is that in this time around, it is the most recent one. All right, it is the most recent one. That is your liquidity. Take for instance, over here is my most recent buy side liquidity, and over here is my most recent sell side liquidity. This is the previous liquidity. Perhaps on the higher time frame, it will be the most recent one on the higher time frame. All right. But on this time frame that I'm working on, this is the most recent buy side liquidity. While this one is the past sell side liquidity that price just this what price just took out. So the liquidity in this particular place have been extinguished. Price have already used it. All right. So because of that, this one will then become the new sell side liquidity, the new point of rejection that price is currently rejecting from. All right. So that's for that. This is the buy side and sell side liquidity that we have in the market. So now let's talk about let's talk more regarding this particular thing because I think it's only liquidity that we have to discuss today. Then in the next class we'll talk about advanced market structure. But before that, let's go on with it. So now let's go back to the internal liquidity first of all. Now, what are the internal liquidity? Just like I said, this external liquidity is more or less if you look at it very small, let's talking about market structure, which is your highs here and your lows. That what external liquidity will tell you, that liquidity is resting on your highs and your lows. But in internal liquidity, it's more or less talking about market mechanics. Internal liquidity, is more or less the liquidity that does what that fuel the market. While external liquidity is the liquidity that market is attracted to. Let's just put it like this. External liquidity is the liquidity that markets want to take out. While internal liquidity, it is the liquidity that we give the market the fuel to go and take out that particular external liquidity. All right. And your internal liquidity are where more or less it is the place that a lot of money will be pumped into that particular market. Like I said, fuel, you need fuel to go and take out this external liquidity. So it is that internal liquidity, that's where money will be pumped into the market. And you know where exactly all these places are, where people will be entering the market more often, which are your market mechanics. So the external liquidity have more to do with market mechanics. Why? External liquidity have more to do with what? Market structure. All right. Later on, when we go over to advance, we most likely figure out that it is the external liquidity that gave rise to the market structure that we are using. But before that one, let's move on to talk about the external liquidity. So take for instance, okay, let me still use here. Now, you can see this rejection, all right? Before markets will reject this particular, it simply means that money was pumped into this particular market. That's why markets started rejecting this particular level. When I say money was pumped to the particular market, take for instance, this is the GDP JPY. So it means that JPY grew more stronger than GDP. And that can only happen when JPY have more money at that particular point in time than GDP, and that will make the market to actually move in the favor of JPY. All right. So with that being said, money, that means JPY gain more value around this particular level. Many people were more interested in JPY around this particular level, and that's why the market pushed down from this particular place. So around there, that's where you most likely see your internal liquidity, which might be in the form of either your order block, your all those components of market mechanics that we discussed about. All right. Why? The external liquidity will be that whole place. Now that the liquidity here have been used, the remaining liquidity will be resting here. And what will happen when next market comes to that place is going to do what? It's going to take it out. All right. That is the rule when it comes to liquidity. So this is the difference between internal and external liquidity. Now, moving on, let's go over to some of the rules we need to look into for external liquidity. In liquidity concepts, there's one thing that is always like, there's one thing that is always being told in liquidity concepts, which is price, take out one external liquidity, and move to go and take out the opposite external liquidity. That's because market keep on hunting liquidity over and over again, right? That's the movement of the market based on liquidity concept. What I mean is this. Now, what have happened? Markets have created a buy-side liquidity at this particular level, right? And since market have created buy-side liquidity, following that rule, markets will take out this buy-side liquidity. Then we pull back to come and do what? After so far markets have rejected this particular level here, there is now sell-side liquidity at this place. So after taking out buy-side liquidity, market will come back and take out sell-side liquidity before the market can then be free to do what? To move to its normal direction. So markets have to take out external liquidity, one external liquidity, and take out the other external liquidity before you can then say that, okay, the market is free to do what? To actually move to its normal direction. That is why in advanced SMC, you will be told to identify your market structure shift first, because that one will give you the direction the market is going to. And that one will also tell you that, okay, market have taken out one liquidity already. You have to, after identifying your this thing, then the next thing in advanced SMC, they will tell you to go and do what? To go and look for your liquidity after identifying the structure of the market. So the structure of the market is when you identify that first part of liquidity. That's why break of structure, market structure shift is always crucial when you're making your analysis. So after that one, what will happen again is the other one that price want to come and take. That is why we look out for liquidity, especially in the lower time frame. Because this one in particular is the one that will be used as the trap. Now, because market have been trending upward, yes, there was a break of structure here. Many people with this do start buying. There will be only few people selling. Everybody wants to buy. So smart money guys won't be able to see a lot of sell orders to fill in their orders. That means smart money guys won't be able to buy in such case. So what will they do? They have to manipulate the market to come and take out liquidity. That simply means that people that bought at this particular level, smart money guys will come and take them out of the market, or take out those who are planning to buy at this particular level, who have pending orders, awaiting to be triggered around this particular level, be it buy orders or sell orders and all that. So over here, we have our liquidity resting at that particular level. And what will happen? Market will have to come and take it out. Once market take it out, there will now be a lot of sell orders in the market for the smart money guys to fill in their position. What will happen after market take it out? Market will have to react from an internal liquidity, because the smart money guys will need more or less a fuel station to actually enter the market, to actually get their fuel from. So they will have to, like, after market take this particular place out, smart money guys will then enter the market and push to the upside. But we retail traders, how are we going to follow the smart money guys? That's when you have to remember what we discussed in market mechanics, that we talk about that market mechanics when it comes to SMC. We want to follow the smart money guys. But that does not mean that you'll just enter market, then you'll just place position. No, you need the level. Place that we tell you that, okay, this is where smart money guys will most likely enter the market from. And we have discussed about all those levels. That does not mean that the smart money guys are entering the market from that level. No, they're not entering the market from that level. Just that whenever they want to enter the market, those levels are most likely in confluence with them. Smart money guys don't even know what they call that block. They know they use them. They don't know what they call breaker block. They don't even they use this our charts. This our candle charts. They know they use them. Now just wait till they form based on smart money interaction. It is in the chart it is most likely around that place. That's where the smart money guys, that means their interaction will be shown in the chart. And that's why we make use of all these other blocks, rejection block, fair value gap, breaker blocks, and all that. QMRO, QML, all those ones. So anyone can be your what? Can be your point of interest. So far you know what you are doing, anyone can be your point of interest. But if you don't know what they do, none can be your point of interest. Sorry about that. So that's for that. This is what we researchers want to do. We want to identify the liquidity that your smart money want to take so that we can then do what? We can then follow them for the main move. This is advanced SMC. All right. So with that being said, that's everything regarding what we want to use liquidity for. All right, the basic liquidity. So in the next class, we talk about advanced SMC. But with that being said, you can see our price is taking out your liquidity here. This is the buy side liquidity, which is denoted by what? BSL. And this is the sell side liquidity, which is denoted by what? SSL. So this is what you need to know regarding the external liquidity. Now in the next class, we talk about how it relates with market structure and then talk about advanced market structure. Because advanced market structure is when you put in liquidity in market structure. The reason why we did not talk about advanced market structure when we talk about complex market structure was because we need liquidity. We need to understand liquidity very well before we can then go on and start talking about advanced market structure. But having done with the basis of liquidity, we can then move on to advanced market structure. So that will be what we'll discuss during the next class. Well, before that, any question? Any question?
No, no question.
All right, then. The next class, we're going to continue